Today we're diving into a powerful option strategy called the poor man's covered call. Now you might be thinking, covered calls, are those for big investors with fat wallets? Well, that's where the poor man's part comes in. This strategy helps you reap the profit potential of covered calls even if you don't have enough money to buy 100 shares of the stock. Sound interesting? Let's talk money. In order to understand a poor man's covered call, you need to first understand covered calls. So what is a covered call? Well, imagine you own 100 shares of Tesla. You're bullish on the stock, but you wouldn't mind some extra income while you wait for it to climb. So you sell a call option, giving someone the right, but not the obligation, to buy your shares from you at a specific price by a specific date. For doing so, you're paid an upfront premium. Now, if Tesla soars past that price by the deadline, you get assigned and you sell your shares for a profit, plus the premium that you received to begin with. But if it stays below, then you keep both the premium and your shares. It's a win-win, right? Let me show you what that looks like. Since you own 100 shares, what you can do is sell a covered call against that position. So in this example, we're gonna assume that you sold a covered call at $220. So you sell a call at $220, and we'll say that you were paid $500 for selling that covered call. Well, as the days go by and Tesla's stock price continues to move, as long as by expiration date it closes under that $220 mark, then you keep your stocks and you keep that $500 of premium that you received, which in most cases is the best scenario, because once that contract ends, you could then sell another contract for a higher price. But what happens if Tesla's stock price ends above the strike price? So again, for this example, we'll sell another covered call at $220, and Tesla's stock price moves, it continues to move, but after expiration, it ends well above 220. Well, in this case, you still keep that $500 of premium that you received to begin with. However, now you're forced to sell your shares of Tesla at $220. So in this case, you get the capital appreciation from $200 all the way up to $220, and you get that $500 of premium that you received. However, you would miss out on any capital gains beyond $220. So let's say, for example, Tesla's stock price ended at $230. Well, you would miss out on that $10 of difference. But what if you can't afford 100 shares of Tesla, or any other stock for that matter? That's where the poor man covered call comes in. Instead of owning the stock itself, you buy a long call option with a strike price below the current market price, and this acts like a cheaper version of owning the stock, as it gives you the right to buy it at a lower price later. Then you sell a short call option with a higher strike price and an earlier expiration date. This generates income up front and limits your potential upside if the stock skyrockets, but more on that later. So imagine a stock trading at $25. You would buy a long call with a strike price of say $20, expiring 24 months from now, and you would receive $725 of premium for doing so. This costs you much less than buying 100 shares outright, which would have costed you $2,000. Then you sell a short call with a strike price of $30, expiring within 1 month. This generates you some immediate income, but if the stock hits, let's say, $33 on expiration, then you'll be forced to sell your long call option at a lower price, missing out on further gains above $30. So here I am in Thinkorswim, and I am on the options chain. So I decided that I wanted to open up a poor man's covered call on Tesla. So first thing I need to do is bring up Tesla, TSLA. And when you are opening up the long call, the one that you are buying, you want to do it at least 1 year out. You should try to buy as far as you possibly can. However, a year is good. So we'll come down here. I'm going to look at March 21st of 2025. That is 399 days from now. So I'll click on it. Now, when you are selecting your strike, I typically select a strike that has a delta of 0.80. So if we look right here, this delta is 0.80, and delta is simply the probability that the event occurs. So it is saying that by this date, there is an 80% chance that Tesla is above the strike of $155. And the reason you want to pick a strike price that is so far into the money is because it allows you to be able to purchase the shares of the stock as long as the stock price is above the strike price on the expiration date. So for an example, let's say on expiration date, 399 days from now, if Tesla's stock price has dropped down to, let's say, 180, well, I can still purchase the shares of Tesla at 155. And that just essentially gives me more time for my theory to play out. So the first step to a poor man's covered call is to buy the long strike. So we're going to buy this $155 strike. And for doing so, we're going to pay somewhere around $6,900. Okay, so keep that in mind, $6,900. But now we need to sell a call at a closer expiration date. So for this, I'm going to go March 22nd of 2024. That is 35 days from now. And I typically pick a strike price at least 10% above the current stock's price. So the current stock's price is $199.95. So I want to go around $220. So if we sell this $220 call, we will receive somewhere around $460 for doing so. All right, so we're going to pay $6,900 for the long call, and then we'll receive $460 for the short call. Now, the best case scenario is Tesla stock price just slowly rises up and the expiration is just slightly below our short call strike, which here is $220, because then we'll sell another call for around 30 days out at a higher strike price. And if everything goes well, you can continue to do that month after month after month, and possibly receive enough premium that pays for your long call to begin with. So you're probably saying, Rashad, that sounds great, but are there any risks? Well, absolutely. While the poor man's covered call offers limited downside risk and income generation, it's not without its drawbacks. You give up some potential upside compared to owning the stocks outright. If the stock price plummets, you lose money on your long call despite the premium you received. And managing the strategy requires understanding expiration dates, strike prices, and the complex world of options pricing. It's not a get-rich-quick scheme, but a calculated approach for informed investors. So a poor man's covered call is best to profit from a slow and steady rise in a stock price and to minimize the cost of a long call. But if you'd like to dive deeper into this strategy and see how I bring in multiple six figures per year trading options, then feel free to join my community and online course called Trade to Freedom. Within this community, you'll be able to see my exact trades in real time, and you'll have access to a full A to Z options course. And the link is in the description below. That is it for today, folks. I'll see you in the next one. Peace.